Financial ratios are key metrics that help businesses, investors, and lenders evaluate a company's financial health. These ratios analyze profitability, liquidity, efficiency, and risk, making it easier to compare businesses and make informed decisions. Why are financial ratios important? Assess business performance. Helps managers track profitability and efficiency. Compare companies. Investors use ratios to evaluate different businesses in the same industry. Identify financial strength and weaknesses. Ratios reveal risks, cash flow issues, and debt levels. Key types of financial ratios. Profitability ratios. Measure how well a company generates profits. Gross profit margin equals revenue cost of goods sold divided by revenue. Shows how much profit is made after production costs. Net profit margin equals net income divided by revenue. Indicates how much profit remains after all expenses. Return on equity, ROE, equals net income divided by shareholder equity. Measures how efficiently a company uses investor money to generate profit. Liquidity ratios measure a company's ability to pay short-term debts. Current ratio equals current assets divided by current liabilities. A ratio above 1.0 means the company has enough assets to cover short-term debts. Quick ratio equals current assets, inventory, divided by current liabilities. A stricter measure of liquidity, focusing on assets that can be quickly converted to cash. Leverage debt ratios assess how much a company relies on borrowed money. Debt-to-equity ratio equals total debt divided by shareholder equity. A high ratio means a company is heavily financed by debt, increasing financial risk. Interest coverage ratio equals earnings before interest and taxes, EBIT, divided by interest expense. Measures how easily a company can cover interest payments. Efficiency ratios measure how effectively a company uses resources. Asset turnover ratio equals revenue divided by total assets. Indicates how efficiently a company uses assets to generate sales. Inventory turnover ratio equals cost of goods sold divided by average inventory. Shows how fast inventory is sold and replaced. Valuation ratios help investors determine if a stock is fairly priced. Price to earnings, PE, ratio equals stock price divided by earnings per share, EPS. A high ratio suggests high investor expectations for growth. Price to book, PB, ratio equals market price per share divided by book value per share. Compares a company's market value to its actual asset value. Example of financial ratios in action. An investor is deciding between two companies. Company A has a high profit margin and a low debt-to-equity ratio, meaning it's profitable and financially stable. Company B has a low current ratio, suggesting it may struggle to pay short-term debts. By analyzing financial ratios, the investor chooses Company A, as it appears to be a stronger investment. Quick recap. What are financial ratios? Metrics used to evaluate a company's financial health. Why are they important? They help assess profitability, liquidity, debt levels, efficiency, and valuation. How are they used? Businesses, investors, and lenders use ratios to compare companies and make financial decisions. Financial ratios provide a clear picture of a company's performance, helping businesses and investors make smarter financial choices.